American Tower, one of the largest REITs in the market, reported a mixed performance in 2022. Despite a slightly challenging economic environment, the company managed to achieve a solid revenue growth with an increase about 15% compared to the previous year. However, American Tower's net income showed a notable decline, dropping by 32% year over year. With these financial indicators, the stock price has experienced a decline of around 13% year to date, and the stock is trading lower than 30% compared to last year. Today we'll take a three-step approach to thoroughly evaluate American Tower and determine its fair value. Step 1. Margin of safety. We'll assess American Tower's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into American Tower's financial statements and assess critical metrics and ratios. In step 3, we'll be using a combination of valuation models such as funds from operations and discounted dividend model to gain an insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of American Tower as an investment opportunity. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. First metrics that we'll be looking at are the margin and the EBIT growth. The EBIT has gone up over the years, growing from over $500 million in 2013 to $2.2 billion in 2022. The average EBIT growth during this period is just under 20%, which is a 5% deduction from a margin of safety. If you look at the margin has gone up as well over the years, going from 17% in 2013 to 21% in 2022. The average margin growth during this period is 5.35%, which is way past the green part in a scale, which awards them with a 5% deduction and a margin of safety, once again. The next metrics that we'll be looking at are the dividend growth and the debt to EBITDA. The dividends have gone up over the years, going from $3.76 a share in 2019 to $6.28 a share in 2023. The average dividend growth during this period is a very solid 14%, which is a 10% deduction from a margin of safety. To determine the debt to EBITDA, we need to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for American Towers, this is over 7 years, in this case a 725% debt to EBITDA ratio, which gives them a 5% increase in the margin of safety, seeing as this ratio is very, very high. And the final metrics that we'll be using are the occupancy rate and the rent reversion rate. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. And as we can see in the chart on the top left, 90% of their properties are vacant, which means 81% of their properties are occupied. This is considered quite low and is no change in the margin of safety on this metric, but it's very close to being a 5% increase in the margin of safety. The rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired. And if we can see, this margin has actually gone down, going from just over 8% to 7.6% in the last year. This means a rent reversion rate of minus 8.5%, seeing as it also had a significant drop in 2021. And this adds another 5% increase in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of American Tower. The first model that we'll be using today is the price to funds from operations mean reversion. The price to FFO, or funds from operations mean reversion, is a valuation model used to assess the attractiveness of a REIT stock price based on historical FFO multiples. Funds from operations is a key metric for REITs as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued, and then is expected to revert to its average over time. In this case, we've imported the price of American Tower in 2021 and 2022, and the FFO per share in 2021 and 2022 as well. The average price to FFO during this period has been $26.07, and the trailing 12 months FFO per share is $10.12, which is pretty close to the FFO per share we had in the past years, but the price has dropped significantly, giving them now a trailing 12-month price to FFO of only $18.39, which is a price per share of this model of $263.82 now, which is almost an upside of 42%. The second model that we'll be using is the dividend discount model. The dividend discount model is a valuation method that calculates the present value of expected future dividends to determine the fair value of a stock. It assumes that the intrinsic value of the REIT is the sum of all its expected future dividend payments, discounting it back into the present using a discount rate that reflects the risk associated with the investment. The model is based on the premise that investors value the income generated by the REIT's dividends, and that future dividends are a crucial factor in determining the stock's worth. In this case, I've imported the dividend payouts of the past 5 years, and on average, the growth rate in the dividends has been just under 14%. And I'm projecting all of their future dividends to grow by 6%, and the discount rate that we'll be applying on American Tower is 8.5%. And looking at all of these metrics, we get a dividend discount model price per share of $266.27, which is a pretty large upside of 43.12% out of this model. The next model that we'll be using is the AFFO multiple valuation. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for its capital expenditures and other non-recurring items necessary to maintain property portfolio. AFFO is considered a more accurate representation of the cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. For this model, we've imported the price to AFFO ratios for similar companies to American Tower, and on average it is sitting at 17.2, while the price to AFFO of American Tower is sitting at 19.5, which is just a little bit higher. This gives us a fair value of this model of $165.27, which is just under a 12% downside out of this model. And the last model that we'll be using is the net asset value model. Net asset value is a straightforward valuation model that estimates the value of a REIT based on the fair market value of its underlying assets minus liabilities. The value of a REIT's assets is typically determined by appraisals of its real estate properties. Net asset value can provide a good indicator of a REIT's intrinsic value. We've imported the net operating income of AMT of the last year, and we have applied a growth rate for this year, which is 8%. This gives them a forward year net operating income of $2.4 billion, and applying a cap rate of 2%, we get a value of their assets of $123 billion. And we of course have to subtract the debt, giving us a net asset value of $76 billion, and dividing this by the amount of shares outstanding, we get a net asset value price per share of $163.07, which is almost a 13% downside of this model. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the price to FFO, discount dividend, AFFO multiples, and the net asset value price per share, giving us an average of $214.59. Margin of safety we've determined earlier using a standard margin of safety of 25%, deducting it by 5% for the EBIT growth and the margin growth, 10% for the dividend growth, and adding 5% for the debt to EBITDA, and adding another 5% for the rent reversion rate, leaving them with a margin of safety of 15%. Applying this margin of safety, we get a fair value of $186.60, and the current price is $187.29, meaning that it's trading very close to fair value per our valuation. If you want to get access to the model that I use in this video and much more models, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.